Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. With us around the table, Vishal Khanduja of Morgan Stanley Investment Management. Vishal, good morning. It's good to see you.
Morning.
We've just had a big month of global easing, which you've recognised yourself. We've had a Federal Reserve cut by 50 basis points. We've had China begin to take on more of an easing posture. Is that a reason to buy bonds or sell them?
I think after the reset, absolutely buy them. I think at 250 basis points till 2025, I think it was a tough slog there, and we were backing away from it. At this point, I think we think it's fair value at this point. But I think the market is getting a little bit carried away with the stimulus, as you pointed out, as well as the one or two good data points that have come out. It doesn't change the trend for us.
Well, tell me what the trend is for you, because it's been very confusing for the rest of us. We've seen contradictory data across the board when it comes to the jobs market. You can pick out the employment components of the ISM, weak, the labour differential, not great and getting worse. Or you could look to headline payrolls in America and just say everything's okay, unemployment's still close to 4%. What is it to worry about? What's the trend for you?
Disinflation is very intact for us. I think Kathy mentioned in the previous slot as well. I think the data points that we are getting within inflation, definitely the ones that are a little bit more volatile are showing up, which we don't think are going to persist for a long time. OER, big component of shelter, is going to drop off, as at least from the indicators that we track. So disinflation is very intact. Economy is still in that exuberant / soft landing phase. So you see the growth perk up from time and again. Labor market being one component of that. We don't think that these cuts that they've announced or they've started off with 50 basis points are anything to resuscitate an economy which is going into a recession. So these are recalibration cuts. They've used that word very, very clearly as well.
Pause. An economy that's going into recession, what signs are we seeing of any potential recession anywhere on the horizon based on everything that everyone's saying, these companies included, about how strong the consumer is?
I think narrative shifts are so severe, and we've seen that since 2022. I think we saw the 250 basis points priced in with two really tough NFP reports where we started to question whether these are because of labor pool increasing or people coming into the job force, or this is because of layoffs. And then I think the market got very tied up with that for probably about 2.5 months. And now we are coming back into it with one very, very strong labor report that comes out. So yes, consumer is strong. Underneath, balance sheets are very strong. We invest in balance sheets. We have bond holders. One quick point also I would raise is this is the issue that we will have if a big chunk of the economy is interest rate insensitive, which is because of the stimulus that you put in, and then you ensued a very low interest rate environment where all of us refinanced at 3% 30-year fixed, very similar to what Comcast.
You say all of us. All of us wish we had done that. Not all of us did.
Some of us did. And
some of us did, and one's around this table and very happy about it.
And some people are pretty bitter about it. But I am wondering, you actually are seeing a tick up in mortgage, at least for financings, as a result of how much things are coming down. The world that you're talking about, with this binary risk of narrative shifts, doesn't speak to a world where credit should be holding in as much as it is. Wouldn't you think if there was a risk that, in particular, high-yield bonds should be just ticking up, showing a little bit of a sign of concern rather than absolutely cratering when it comes to the extra spread that investors demand to own over benchmark rates?
Very fair. We are trying to demand a little bit, and we are getting priced out. So we are at the lowest point of high yield in our portfolios for that one reason. I think if we slot it in the way of how we look at the world, fundamentals, technicals, valuations, fundamentals are strong. You can take a few companies out of that picture who are idiosyncratically going through issues right now. Technicals are fiercely strong, and that is less of a spread buyer, more of a yield buyer that is coming into the market. Real yields are high, and yields are best predictor of total returns analyzed for the next 3 years.
When we look at spreads and spreads exclusively, and we compare them to a different period, and we say they are just as tight as they were back then, multi-decade tights. How different is the index now versus, say, pre-GFC? How different is this one?
Much cleaner. Balance sheets are much, much stronger. Even if growth flatlines from here at 1 to 2% real GDP, I think we will be just fine. As coming back to that homeowner example, I think a lot of balance sheets can have connotations.
So can I just ask an additional question?
Please.
And I know it's difficult, and I don't expect you to have a precise answer, but typically, historically, 300 basis points, 250 on high yield is super, super tight. Do we need to rethink that? Is the new number like 200, 150? What is it?
Could be, absolutely could be, if CCCs continue the carnage that they've been on probably over the last 2.5 months here. Idiosyncratically, if you take out distress from high yield, it's another 50 basis points already there, to your point, around that low 200s, if you will. We think that spreads are very commensurate to the fundamentals and technicals we are going through. We could be tight and frustratingly tight for a long period of time, but we are not expensive at this point. Now, second statement right after that is,
sure,
we are at the lowest amount of spread risk in our portfolios in a long time. Highest quality, highest interest rate duration.
Well, explain
and
why.
Steepeners. We don't think that volatility adjusted, you're getting paid for the spread risk that you're taking on. BBB to BB is the lowest in probably about 2 decades at this point. As a spread investor, I'm always looking for more premium. I need to get paid for that volatility that I'm taking on. So for fixed income portfolios, I can still diversified, high quality, can still spit out probably 5 to 7% total return in the next 3 years analyzed. So I'm taking that probability bet higher versus going down below investment grade.
When you take a step back, you said that the technicals are very strong for credit, for bonds just in general. There's a flood of cash coming in. Where is that cash coming from? How much is coming from people who are waking up to the realization that they're not going to get Social Security or some of these other benefits when they're old and need the income, and they're going to need to really be invested and get something more reliable?
Yeah, no, I think the lock-in yield effect is very compelling at this point. I think except for the very front end, the 0 to 2, 0 to 3 year part of the curve, where I think the SOFR should adjust as the Fed comes down from the lofty levels, I think every other part of fixed income curves have already adjusted to be steeper. So the roll down, the traditional way of earning money within fixed income, and sometimes the cliched way of how we put it is the dual mandate of fixed income has high probability to be met for that long-term saver, that you have income total return, and then you have the negative correlation to risky assets, which is back as inflation is coming down.
How do you hedge against the potential for some sort of geopolitical disruption and oil prices surging? I mean, there's sort of this counterintuitive connection between bonds and oil prices that we've seen over the past few months. How much are you really planning for a scenario of that type?
I think it's tough to massively shift portfolio positioning for that one. I think the one way that we are trying to adjust portfolios is that we are overweight risk, we are overweight credit risk, not as much though over the last 3 years, if you will. So we are at the lowest point of our overweight. We still have an overweight posture that if these geopolitical tensions do flare up even further, which we had a few signs in the last 2 to 3 weeks that it could have, that we have enough potential to add below investment grade risk, which will sell off and react to these geopolitical tensions. And then the back end of the treasury curve is one more, less geopolitical, more deficit situation that we are significantly underweight.
Are you worried about the deficit?
We are nauseous about it. In terms of the biggest post-war, again, we can throw out stats all day long, but I think the way it affects is you need to grow out of it, or you need to do something, as some of the European countries are already getting onto, is be fiscally responsible and going through some tough times.
Do you actually think Washington would do something?
Very tough. I think that is one thing that they are, deficits in China is one thing, how common those two campaigns are on and how aligned they are, unfortunately, at this point.
If the deficit is one of your biggest concerns, especially surrounding the U.S. election, I guess what matters more for you is probably the composition of Congress. How are you thinking about that?
I think the base case, I think we are looking at the same numbers that you guys report on the terminal, et cetera, as well. Dead heat, but then Senate and House will be split, which is actually not a bad thing for deficits. We might be looking at a Goldilocks, even treacherous Goldilocks type of scenario from
that's the least bad outcome. The least bad outcome. Split Congress because they won't make it too much worse. That's basically it, but not fix it.
Yeah.
Vishal, it's good to see you. Appreciate it. Thank you.
Thanks for having me.
Vishal Khanduja there of Morgan Stanley.
Hunt of Alpine Saxon Wood saying, with earnings multiples at robust levels, any faltering in the growth story could have negative consequences, even if it is more of a stable outcome versus a deterioration. Earnings growth is key for equities. Sarah joins us now for more. Sarah, good morning.
Good morning.
Good to see you. What do you make of the banks so far? Big week of gains last week off the back of JP Morgan and Wells Fargo. Numbers from Bank of America about 20 minutes ago.
I think that is a good start, and I think that has obviously been heralded fairly well. I mean, you saw the other financials besides JP Morgan move higher on Friday. I think to your earlier discussion, it's going to be very interesting to see how the credit companies do, or how the banks do with the lower credit score folks, because I think that's where you're seeing much more pressure and pain than you are seeing in the upper end. So we'll see how that goes. But I think that the fact that you're seeing enough spending and that the consumer looks good, and even if you're looking for it, you're having trouble finding it, I think that's good news.
Sets up retail sales on Thursday as well. Any reason to think that we come in soft on retail sales, given where the consumer is?
I think that's hard to see right now, but I mean, you might have some areas of softness, but I think in general, people are still spending fairly well. It's too early to catch up for all of the economic disruption that the hurricanes had. So I think that you probably are going to see reasonably good numbers.
So this is what a lot of people are expecting. The consumers have plenty of money, and that any degree of weakening, even in the savings rate, has been really tampered down by some of the recent revisions. What's stopping you from just going full bull?
Well, I think there's still a lot of things that we don't know. There's a lot of uncertainty out there. We've got an election coming up. Yes, it seems like things have calmed down a little bit in the Middle East, but is that calm going to remain? And just because we've got reports of that doesn't necessarily mean that we know what the outcome is going to be yet. So I think that there is enough out there that you could be concerned about. And I think that you have next year a big expectation in earnings growth, so you want to see that economy continue to roll along fairly nicely. And I think that there's, like I said, there's enough out there that you could get yourself upset about or scared about, including the deficits and things that we're not talking about right now. But at the moment, that's not the focus. So right now, that's good for equities.
You're basically describing the story of my life. I can go home and worry about a lot of stuff, but you come in the next day and nobody really seems to care about it. I am wondering whether we are seeing the risks getting skewed to the upside in terms of economic growth. We were talking to Max Kettner, who was talking about the real tail risk to him is actually an upside to inflation and a reignition of some of the price increases that we saw, that this could actually create the doomsday scenario that could actually stop some of the euphoria that we're seeing in equity markets. Is that the risk to hedge right now, given the lack of visibility of any other risks, particularly with respect to the consumer?
I think it's a big issue. I think the fact that oil prices have come down so sharply helps a little bit on the inflation front, but I think that that's one of the areas that if you see, you saw an upward CPI print just a little bit, and all the directionality sort of shifted. And is it a full shift? Is it a small shift? I think that is one of the bigger risks, because that's going to keep the Fed from acting as decisively as it could if you have any weakness in the labor market.
So where do you want to be in equities right now? What's your favorite place to be?
I think you want to be sort of across the board, which sounds really boring and annoying.
Is that Lisa's equal weight?
Well, I don't think you want to ignore the equal weight the way that you did the last time, right? So before it was all about technology stocks, and if you were underweight technology stocks, you were underperforming really badly. I think at this point, the diversity and the fact that you need technology, but you also want to see what else is going on in the economy, I think that's really come back. And I think that that's why you want to be somewhat across the board as opposed to having all your eggs in the technology side.
Is there a theme that you want to run with? This is what Mike Wilson and Morgan Stanley was talking about on this show, that we moved from GLP-1s to AI, this big NVIDIA move over the last few years. Is there another theme you want to run with that works right now?
I think that it's good to understand what is going on with thematic investing. I think that what you're seeing with the European car makers right now is they're saying, hey, hang on a second, we're not going to be able to go full EV in 10 years. That's not going to happen. I think understanding the fact that you're going to have an and on the energy front is going to be important. I think it's important on a thematic sense to look at companies that have continuously good balance sheets and can really generate cash, because that's what's going to be more problematic. Even if rates don't come down dramatically but stay a little bit higher, you're going to start to see some of those companies that can't survive on their own have more problems. And it hasn't really been an issue yet, and credit spreads are really tight. But I think that focusing on companies that are able to do things like buy back their shares and pay dividends is going to continue to be very helpful.
You mentioned the U.S. election. In your notes, you talk about the political risk and volatility for equities. What happens when we don't know the outcome for potentially days or weeks?
I would not like to see that happen. I don't think markets would like to see that happen. I think if it looks like any kind of protracted fight, I don't think that that's going to be healthy for equity markets. But at the same time, we're almost, inured is not the right word, but we have had problems before and we have gotten through them. So to the extent that we've had challenges and yet we all come back to a point where there is an acceptable answer, I don't think it's as bad as it could be, but I do not think that equity markets would like that very much at all.
But are they even pricing in this probability right now?
I do not think that. No, I don't think so. I think that they're not even pricing in a probability of a sweep of one side or the other. I think they're still pricing in a probability of a mixed government because that's generally better for equities because things don't move as fast, right? You can't make changes as quickly.
So the equity market is pricing in what they would like to be the outcome, not potentially what is going to be the outcome. Mm-hmm. Yeah, that's pretty dangerous.
And that's very equity market-like, though, isn't it? I mean, isn't that what equity markets do? It's like, what do we want to happen? We're going to try to telegraph that and make it happen. You know, if we keep moving this way, maybe thus it will be so.
We are deep in the heart, we're getting to the heart of earnings season. Which sector are you most interested to hear from? We've already heard from some of the banks. We're going to be done with basically the big bank earnings by the end of tomorrow. Which really will be the company or slew of companies that give you the best sense of whether people are a little bit over their skis in terms of risk?
If you think about what's going to drive what we think about the consumer, you're going to be looking on all the consumer side stuff. But if I think about the entire economy, I want to hear what the industrials have to say. And I want to see what they have to say about margins, what they have to say about labor costs, material costs, because that's going to set us up for 2025. And that's, I think, the big question. It's like, okay, we've seen some really good earnings growth in 2024. We're expecting more earnings growth in 2025. Do we have the underpinning ability to do that and to get those earnings through? Because if we do, then the bullishness is not wrong. But if you're starting to see cracks in that, and you saw individual, is that idiosyncratic? Is Nike having a problem because Nike's having a problem? Is this having a problem? If we see broader problems like that, I think that then the question starts to come, what's happening next year? If you don't and you see much more stability and you see companies saying, hey, you know what, we've really got a handle on these costs and we're able to push prices just a little, just enough to keep margins in good shape or growing a little bit, I think that's going to be important.
Is there any sector that you're just completely avoiding?
Not at the moment, but I think that there are places where you want to be careful. And you're always looking for companies within individual sectors that have their own dynamics. But at the same time, I think some of the consumer, you have to be a little bit careful for reasons like Nike and the individual idiosyncratic problems that you can see. But I don't think that there's anything that you would say, absolutely, I want to stay away from here. I mean, it's interesting that the IEA is taking numbers down for demand, and yet we're taking global growth numbers up for China, right? So one of those things is not correct. Where you go from there, I don't know. Materials have certainly been hit pretty hard on the back of both oil coming down and some of the other stuff. But I don't think that you want to be completely out because there's still places to make money in those sectors.
Sarah, it's good to see you. Sarah Hunt of Alpine, Saxon. We begin this hour with stocks at all-time highs as earnings season ramps up. Max Kettner of HSBC still bullish. A powerful combination of dovish Fed, China stimulus, low near-term EPS expectations and subdued sentiment leaves us very bullish on risk assets. We find it incredibly tough to form a bearish narrative from here. Max Kettner joins us right now. Max, you've talked about why you're bullish. Let's talk about where you're bullish. High yield credit, overweight even with spreads this tight, Max. Why?
Yeah, good morning. I think, look, when you look at Euro high yield credit spreads, actually they are still, pricing in a bit more premium than the US high yield counterparts. We did close the US high yield overweight that we had really for a long time earlier this month. Overall, however, I don't think, it's an environment where you want to be in risky credit over equities anymore. I think it's particularly, you want to be in equities in particular. Yes, you want to be a bit overweight in emerging market debt and high yield credit in particular, but this is the environment, this is the sort of environment that Lisa was just describing, that is the any news and all of the good news is, or all of the news is good news, and that is particularly favorable for equities and in particular for the US.
This is echoed in the fund manager survey from Bank of America this morning, Max. I went through the line a little bit earlier, but really it sounds like you wrote it. The biggest jump in investor optimism since June 2020 on Fed cuts, China stimulus and a soft landing. Max, the question you ask in your own research of yourself that you get asked all the time, what would it take to make you bearish? Is that question alone what makes you bullish?
Not alone, but definitely it's one of them. When we look, for example, at our sentiment and positioning indicators, the interesting thing is that actually the bearish and the bullish signals, so the buy and the sell signals, are still pretty much on balance, pretty much the same. So what we're seeing is that sentiment overall is still pretty neutral. So I think, at least when we speak to investors, sort of the overall backdrop is investors are pretty constructive, they're pretty positive, but I think overall there's still a bit of caution going into the election, going into, you've got geopolitical uncertainty, you don't really know around the labor market. Fine, we had one good print around the labor market, but is it really out of the woods? So there's a few questions around the cracks in the labor market as well, around the strength in the US economy, and that keeps, investors in a really, really weird position where they keep telling us, yeah, we're kind of constructive, but at least, in the near term, a bit more cautious, and that is reflected in our sentiment and positioning indicators in the last couple of weeks. Throughout that, actually, we had them closer to a buy signal, despite equities at an all-time high, than closer to a sell signal, and that alone is really part of the reason why we're so constructive and so bullish.
Max, there was a time when no landing was thought to be negative for stocks, because essentially what that would mean would be inflation that didn't come down and bond yields that remained high. Why is that no longer a concern?
I think it will be a concern again when it's properly no landing, when we really start talking about, hey, can the Fed not cut at all anymore, or may they even have to reverse course, and may they even have to hike again? Let's remember that was the case what we had in 2022 when, all of a sudden in all of these episodes, there was way more rate hikes being priced in, and that was the time when credit spreads suffered, when equities suffered, where pretty much everything sold off. We had the same environment in September, October last year, again, where we had Jackson Hole saying it's higher for longer, we can't cut rates at all. We had the same environment in March, April this year, when the rates market was starting to price a possibility of rate hikes. Once that comes back, and once that is really properly coming back into the pricing, then it will become a problem for valuations across all the risky assets. But let's be honest, right now, we're so far away from that, right? We've gone from sort of 9, 10 cuts by the end of next year, we've gone to 6 cuts. So what? That's just a reflection of good growth, good earnings growth, good profitability, good GDP growth, and we'll take it, right? And only once really we're going to see sort of a 180-degree shift, the Fed not even saying pausing, but we're done. That would be a problem, I think, for risk assets.
So is that, just to put a bow under this, how much are you basically saying that if the Fed were to come out and say that they were only going to cut by 25 basis points this year and only had a few more before they might reach neutral, that could be a catalyst, or it really has to be something more definitive where you start to see inflation re-accelerate in a material way?
No, I think it would have to be something more definitive, and it would, to put it a bit more precise, I think it would have been, or it would need a really 180-degree shift from what Powell said during Jackson Hole. Remember, Jackson Hole 2 years ago was saying, he was saying there will be pain for households and businesses. That's what we need. That is what is required to bring inflation down. Last year in Jackson Hole, it was all about higher for longer. This year, it was all about we don't like more pain, we don't seek more pain, we don't welcome it, we'll act against it. So it's literally bringing in the Fed put again. And let's remember that's a way, way different level of rates compared to the 2010s. They've got an awful lot of room to cut. So if, say, for example, one of the next 2-3 payroll data actually do come below expectations, they have a lot of room to say, fine, now the next time we'll go 50 again, and that can cushion any downside for risk assets. So the Fed put now, I would argue, is much more credible even compared to the 2010s. So it would need a really, really dramatic, much more significant shift to become a problem and start becoming a problem for risk assets.
Max, when you look at the Bank of America Global Fund Manager survey released this morning, the 3 top tail risks are geopolitics, inflation, U.S. recession, in that order. What do you rank as the biggest risk?
No, I think it is actually inflation. It is the rate side of things. I mean, overall, we've got to figure out what is the biggest one. Is it more towards recession, or is it more towards inflation and rates? If you are of the view, like we've been for the last 2 years, that the US is not going to go into recession, that really the market is underestimating the strength of the US consumer, the strength of the underlying US economy, then by definition, your biggest risk has to be rates, and at some point perhaps yields increasing by so much again again either the velocity or the level that it starts becoming a problem for valuations across the board again. The reason why I also think it's because it's the biggest risk, because if that really materializes, there is nowhere to hide. Remember in March, April this year, or Q4 last year, everything sells off. It's equities, it's credit, it's emerging markets, it's rates, everything sells off, and the only place to hide is the dollar. So from a hedging and from an asset allocation perspective, it is by far, I think, the biggest risk.
So given how bullish you are you potentially in the no landing camp now?
I wouldn't call it no landing. So I think the market really always exaggerates a bit, right? You guys were talking about short-term inflation expectations. Let's remember, we started at sub 2% short-term inflation expectations at the start of the year. They went all the way up almost to 3%. We went down to 1.7. We're back up to almost 2.5. We're backing down a bit. So the market always goes from, oh my God, it's total no landing. No, it's total soft landing. It goes from one extreme to the other. I think the reality is that inflation, we had this inflation shock, we had disinflation, and now we're just not quite down to 2%, right? We're a bit stuck. That is actually not a problem. It's not a problem at all for earnings. It's actually good for earnings because it's a nominal figure. It's good for nominal growth, and that I wouldn't call it no landing. I think the market is getting a bit too obsessed around these definitions and always swings from one extreme to the other. I would say it just continues to be a really supportive environment for nominal growth, and that is an environment that is particularly supportive for equities.
Hey, Max, still bullish, and it's good to catch up. Max Kettner there of HSBC with your equity market at all-time highs.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.